Buy rating by value and momentum portfolio. Mid-cap water infrastructure company. Stock target price forecast and full valuation analysis. June 2026. Welcome back. Today we're digging into a name most of Wall Street is filing in the wrong drawer. It's a water midstream company in the Permian Basin. And the way the street models it tells you almost everything about why there might be an opportunity here. Before I go further, the usual reminder. This is research, not advice. I may hold a position. Do your own work. Why now? Let me start with the core mistake the market is making. Most sell-side analysts treat company like a traditional energy midstream business. They tie its volumes to active rig counts and the price of oil. And on the surface, that sounds reasonable. But it misses how the basin actually behaves. Here's the thing. As wells in the Delaware Basin age, they produce more and more water for every barrel of oil. That water-to-oil ratio is climbing about 3 to 5% a year in the core areas. So even if oil drilling stays flat or even shrinks a little, operators still have to move a lot more water just to keep their oil flowing. The volume grows whether or not the rig count does. There's a second piece the market is underrating. The company is shifting water from trucks to pipes. Right now, consensus assumes flat EBITDA margins around 50.5% for 2026. But when you move water through a permanent pipeline instead of paying a third party to truck it, your cost per barrel drops a lot. The company is moving fragmented, unpiped volumes into its own gathering network, and that should push EBITDA up by the fourth quarter of 2026. When it does, the street has to revise its numbers higher. And there's a regulatory wall protecting all of this. The local energy regulator is clamping down on new deep well disposal permits because injecting all that water has been causing small earthquakes. The company already holds the permits and the underground pore space it needs. A new competitor would have to replicate that footprint from scratch, which is expensive and slow. That's a real barrier to entry. So here's the setup. The company just finished a big corporate combination. The heavy building is mostly done. It's moving out of a spending phase and into a phase where it harvests cash. This company is WaterBridge Infrastructure, ticker WBI. Let me put some numbers on the call before I get into the details. The stock trades around $29. The rating here is overweight, buy, high conviction. The 12-month price target is $38, about 31% upside. Longer term, the discounted cash flow work points to fair value somewhere between $42 and $48. The hard stop loss is 18.50, which would be a 36% loss. The bear case lands around 21. Risk versus reward works out to roughly 3.7 to 1 in favor of the upside, with about a 71% win probability. And the implied 5-year return at today's price is 18.7% against a cost of equity of 10.3%. That's the headline. Now let me walk you through how we get there, what the company actually does. WaterBridge handles produced water for oil and gas operators in the Delaware Basin. It was incorporated in 2025, headquartered in Houston, and it went public in September 2025. The business is simple to describe. There's one core segment, produced water handling and disposal, gathering pipelines, skim stations, saltwater disposal wells. As of the first quarter of 2026, the company moves about 2.5 million barrels of water a day. That core segment is roughly 91% of revenue and about 94% of gross margin. So this is essentially a one-product company. The rest, about 9% of revenue and 6% of margin, is water solutions. Recycling, brackish water sourcing for fracking, a few small gas assets. The company markets this as a circular economy story, but really it functions as a service that keeps customers loyal. It's not the profit engine. Why does anyone pay for this? Because water's a bottleneck. If a producer can't clear water away from a wellhead, it has to shut the well in. Production stops. So operators hand off their water logistics to a company like WaterBridge to keep oil flowing and to avoid building disposal networks themselves. The market backdrop is strong. The Delaware Basin has roughly 27,600 economic drilling locations left. And here's the structural piece. The basin produces about 4 times more water than the industry needs for fracking. So you can't just recycle your way out of the problem. Permanent disposal underground stays mandatory. Waterbridge has about 5.1 million barrels a day of capacity across 2,651 miles of pipe. Full-year volume guidance sits at 2.525 to 2.725 million barrels a day. It's the dominant player in the outsourced commercial market, the moat. So how durable is this advantage? The honest answer is narrow but real. It's a physical moat. Once a pipe connects to a wellhead, switching away is painful. If an operator goes back to trucking, their cost per barrel jumps from the piped rate of about 81 cents up to somewhere between $1.50 and $2.50 a barrel, plus all the road and safety headaches. So customers stay. There's a scale advantage too. Waterbridge runs the largest pure-play produced water network in the country. If one disposal well shuts down, it can reroute water through the network. A single well operator can't do that. And those disposal permits from the Texas Railroad Commission are getting harder to obtain because of seismic activity, which makes the ones Waterbridge already holds more valuable. But I want to be fair about the limits. This isn't a wide moat. 2 reasons. First, it's a capital trap. The basin keeps producing more water, so the company has to keep spending to keep up. That spending caps how high returns can go. To handle 8% volume growth in 2026, management has to spend between $430 and $490 million. Second, there's regulatory risk it can't engineer away. Injection caps, earthquake rules. Management can manage around them, but not eliminate them. So a strong, defensible position built on geography and contracts rather than technology. Just not bulletproof. The contracts and the project pipeline. Now let's talk about the quality of the revenue, because this is where it gets interesting. The contract structure mirrors what the big investment-grade pipeline companies use. Long-term, fixed-fee contracts, built-in inflation escalators tied to CPI, and minimum volume commitments, which protect the downside if volumes fall. On the fixed-fee portion, the company has zero direct commodity exposure. The CFO said on the first quarter call that volume converts to revenue with high predictability. The customer list is solid too. The Diamondback, Chevron, Coterra tier of Delaware Basin operators. One gap to flag. The company doesn't disclose customer concentration, and it doesn't report a formal backlog number the way a tech or defense firm would. That's a transparency issue, not an operational one, but it's worth knowing. Now the growth projects, 3 of them matter. First, Speedway Phase 1. This is a long-haul disposal pipeline, 500,000 barrels a day of capacity, going into service in mid-2026 on schedule. It's already fully committed through 2028 via minimum volume commitments, so revenue ramps with volume and the floor protects the downside. There's a 2-year ramp to full use, but management locked in the construction cost before recent tariff increases, so it's insulated from steel and resin price spikes. And there's a bonus. More than 100,000 barrels a day of uncommitted capacity available right now on interruptible contracts. That's not in guidance. It functions like a free call option on premium priced barrels. Second, Speedway Phase 2, up to another 500,000 barrels a day. The open season closed in April 2026, and management said the results were strong. The catch is the final investment decision. The FID hasn't been confirmed yet. Documentation is ongoing. Construction is expected to start in the second half of 2026. This is the binary event. If it's approved, it re-rates the stock. If it slips, the thesis gets pushed out. I'll come back to this because it's the single most important catalyst. Third, Kraken NGL. This pulls natural gas liquids out of the produced water as a byproduct. It's ramping in mid-2026. It's tied to existing volumes, so there's no incremental volume risk. And it's already nudging margins up from 18 cents to 20 cents a barrel. The CFO called out skim oil pricing as a source of upside that isn't in guidance. Small but accretive. And then there's a fourth thing, more speculative. Beneficial reuse. There's a 2-gigawatt data center planned in Reeves County called PowerBridge, and Waterbridge is the dominant water handler in that county. The company says it's in active discussions, but no terms have been disclosed. For now, treat it as a pure option worth nothing until proven. The quality inflection. This is the heart of the story, so stay with me. The argument isn't just that WaterBridge is good, it's that it's getting better, and the rate of improvement is accelerating. The numbers are inflecting all at once. Start with margins. Gross margin expands from 60% to 65% over the forecast. EBITDA margin goes from 51% to 58.5%. The question is whether that's real operating leverage or just cost cutting. The answer is leverage. Every incremental dollar of revenue drops between 56 and 88 cents straight to EBITDA. That's far above the average margin, and it's the signature of scale economics. Once the pipe is in the ground, extra volume costs almost nothing to move. Now, capital efficiency, which is the core of the case. Return on invested capital crosses the cost of capital in 2028. ROIC climbs from 4.4% up to 12.1%. The cost of capital, the WACC, sits at 8.8% the whole way. So the company goes from destroying economic value to creating it, and the spread keeps widening to over 3 percentage points by 2031. Return on equity tells the same story, from 3% to 11%. And here's the important part. That improvement happens while the company is paying down debt, going from 3.2 times net debt to EBITDA toward under 2 times. Normally, deleveraging is a headwind for return on equity. The fact that ROE rises anyway tells you the improvement is operational, not financial engineering. Then there's the return on new capital. The new projects, Speedway and Kraken, earn about 18% after tax on the money deployed, well above the 8.8% cost of capital. When new capital earns more than the existing base, the blended return gets pulled higher as those assets season. That's the engine behind the 2028 crossover. And finally, the cash. This is the cleanest signal of all. Capital spending as a share of revenue collapses from 53% in 2026 down to 7% by 2031. Free cash flow goes from minus $142 million to positive to almost twice net income. Depreciation crosses above capital spending in 2028, which is the classic sign of a business that's done building and is now harvesting. So put it together. 3 structural lines cross at the same time in 2028. ROIC crosses the cost of capital. Free cash flow crosses 1 times net income on its way to 2 times. And capital spending falls below the harvest threshold. That's the pivot from average to good, happening on a contracted fee-based asset base. There's one thing to verify. Stock-based compensation isn't fully disclosed, and there's a gap between adjusted and GAAP earnings. The cash flow inflection is the cleaner signal, but the earnings quality needs confirmation against the filings. Worth keeping honest about. The financials. Let me ground all of that in the actual numbers. The company is young, only about 8 months of public history, so some of the early figures are partly reconstructed. Keep that in mind. Revenue is growing fast, but earnings per share have been inconsistent. The third quarter of 2025 missed. The fourth quarter missed. The first quarter of 2026 came in close. 8 cents against a 9-cent estimate on $201 million of revenue. On margins, the model uses a steady 60% gross margin, supported by the $111 million of adjusted operating income the company posted in the first quarter. Quick clarification, the 20 cents per barrel figure management likes to cite is a net throughput margin, not a GAAP gross margin. Different things. Management raised guidance on the May 7th call. Full-year EBITDA midpoint of $445 million. The first quarter already came in at $102.9 million, a 51.2% margin. Before 2026, margins were down around 40% because the network didn't have the scale it has now. Full-year 2026 earnings per share build to about 52 cents. With 124 million shares outstanding, depreciation runs around $278 million a year on capital and cash. Management guided 2026 CapEx between $430 and $490 million. Call it $460 at the midpoint. Operating cash flow should land around $318 million. Because of all that spending to finish Phase 1 and start Phase 2, free cash flow stays negative through 2026 and 2027. The inflection is 2028, when the spending cycle winds down and free cash flow turns strongly positive. Here's the revenue arc. $872 million in 2026, growing to $1.543 billion by 2031. EBITDA goes from $445 million to $902 million. Free cash flow goes from minus $142 million to positive $54 million in 2027 to $355 million in 2028, all the way to $676 million by 2031. On the balance sheet, as of the first quarter, total debt of $1.486 billion, cash of about $51 million, so net debt of $1.435 billion. That's 3.2 times EBITDA. The covenant limit is 3.3 times, and the long-term target is under 3.0. They have a $450 million revolver available. Interest coverage is 4.6 times, which is adequate but not comfortable yet. By 2028, on higher EBITDA, that coverage should expand to nearly 7 times. The path to the under 3.0 leverage target is achievable by 2028 on EBITDA growth alone, without issuing new equity. Valuation. Now, what's it worth? I ran this through several lenses, and they mostly point the same direction. First, the right multiple. For this business, it's EV to EBITDA, and it's not close. Earnings are distorted by heavy depreciation, so the price-to-earnings ratio is unreliable. Free cash flow is temporarily negative, so price to free cash flow is meaningless right now. EV to EBITDA strips out the capital structure noise and captures the contracted earning power. WaterBridge trades at about 10.1 times next 12-month EBITDA against a peer median of about 9 times, so a 12% premium on the surface. Is that premium deserved? I'd argue yes, and maybe more. WaterBridge is growing revenue roughly 4 to 8 times faster than the peer group. It owns the biggest network in the basin, and its margin has a credible path to 58%. A fair multiple of 10.5 to 11.5 times would imply $31 to $34 a share. So the current price is, if anything, a slight discount to growth-justified value. Now the discounted cash flow. The base case averages around $48, about 67% above the current price. The more conservative exit multiple version lands at 42. Even in the most punishing corner of the model, high discount rate, low terminal growth, you still get 34, which is above today's 29. The takeaway, if you believe the operating model at all, it's hard to push the DCF below the current price. Then I flipped it. A reverse DCF asks, what is the market actually pricing in at $29? The answer is striking. To justify today's price, you'd have to assume the business shrinks 2.7% a year forever. The base case assumes 2.5% growth. So the market is applying a heavy discount to everything past 2028. It's pricing the company as if the cash ramp never arrives. The sum of the parts tells the same story. I valued each segment separately: the core network, Speedway 1, Kraken, a probability-weighted Phase 2, and a placeholder for the data center option. That adds up to about $37.72 a share, roughly 30% upside. And when I work that backwards, the market is effectively assigning negative $475 million to Phase 2 in the data center. It's treating future growth as a liability, not an asset. That's the central disconnect. Then I ran a Monte Carlo simulation, 200,000 trials, varying growth, margins, the discount rate, and the exit multiple, and importantly, letting the bad outcomes cluster together the way they would in a real downturn. The results: the median outcome is 36.72, the mean is 38.40, the downside 10th percentile is about 21, and the upside 90th percentile is about 58. The single number that matters: only about 29% of simulated outcomes leave the stock worth less than today's price. So in roughly 7 of 10 modeled futures, the stock is undervalued even after deliberately fattening the downside tail. The biggest driver of the outcome, by far, is volume growth, which is exactly what Speedway Phase 2 controls. Last lens, the return math. Buy at 29, hold 5 years, exit at a normalized multiple on 2031 free cash flow, and you get an 18.7% annual return. That's well above the 10.3% cost of equity. And here's the key nuance. Almost none of that return comes from buying cheap cash flow today because there isn't any today. It all comes from the cash flow inflection after 2028, plus paying down debt. We're actually assuming the multiple compresses, not expands. So this isn't a bet on the market paying up. It's a bet on the business growing into its price. To lose money permanently on a flat 5 years, free cash flow would have to come in 34 to 58% below plan, or the stock would have to be priced at a distress multiple. That's a structural impairment scenario, a volume collapse or a phase 2 cancellation, not a mild miss. Put those together and the margin of safety sits around $33 to $34, and fair value is around 42. At 29, the stock is roughly 13% below the margin of safety line and about 31% below fair value. What analysts and institutions are doing. This part is constructive. Initial coverage back in October was cautious, but over the last 6 weeks, 3 banks have turned positive. Morgan Stanley upgraded to buy with a $38 target. Goldman Sachs upgraded to buy at 36. Barclays confirmed buy and raise to 33. So the average of the top 3 targets is about 35.70, roughly 23% above the current price. On the institutional flows, there's an interesting pattern. The long-only fundamental funds, Horizon Kinetics, Schwartz, Loomis Sales, are building positions, some of them adding aggressively after earnings. Horizon Kinetics is the largest holder. On the other side, there was a cluster of selling on May 15th, Millennium, Adage, a couple of others, right when the stock touched its highs above 31. That looks like profit-taking at resistance, not a change in thesis. And one technical overhang to know about. There's a secondary offering of 83.25 million Class A shares registered for resale. That's pre-IPO investors selling, not the company issuing new shares, so it's not dilutive. But it does create supply pressure. Hamilton Lane selling about $20 million worth in April was part of that. It's a known disclosed pressure, and frankly, it's part of what creates the accumulation opportunity. Catalysts and risks. Let me bring the catalysts together, then the risks. The single most important event is the Speedway Phase 2 final investment decision, expected in the second half of 2026. That's the one that matters because volume growth is the #1 driver of value in the model. If Phase 2 is confirmed, it re-rates the negative value the market is assigning to it, and it pulls the whole distribution higher. The math suggests that single announcement could move about $540 million of risk-adjusted value from a 50% probability to over 80%, which works out to roughly $2 a share at current multiples. After that, watch the quarterly prints on the way to the 2028 cash flow inflection, and watch leverage cross below 3.0 times, which removes the overhang on the multiple, and keep an eye out for any data center supply agreement, which would be pure upside, not in the numbers. Now the risks, honestly stated, the biggest one is commodity cyclicality. A sustained drop in oil slows Permian drilling, and volumes would lean on those minimum commitment floors. That's the core beta, and it's real, though the floors in the rising water cut partially offset it. Second, Phase 2 could run over budget on steel or resin or labor, which delays the cash harvest, though the resin is partly pre-bought. Third, regulatory and seismic risk could curtail disposal wells. Fourth, that 83.25 million share overhang. And fifth, leverage at 3.3 times during a heavy build cycle, which means a cost overrun could squeeze the covenant. The thesis breaks if Phase 2 gets canceled, if the company does a dilutive equity raise, or if net leverage breaches the covenant. Any one of those invalidates the volume story, the bottom line. So here's where it all lands. WaterBridge is a capital-intensive, high-growth midstream business in the early innings of a multi-year build. It owns the largest produced water network in the Delaware Basin, an asset that's structurally supply-long and demand-critical. Revenue is growing about 65% in 2026, driven by Kraken and Speedway Phase 1, both on schedule. It's free cash flow negative this year by design, not by distress, and it becomes a real cash generator from 2028. The core argument is this: the market is pricing the trough as if it's the destiny. WaterBridge screens expensive only because it's at the peak of its spending cycle. The reverse models prove the error. One implies the business shrinks forever. The other assigns negative value to its best growth project. Meanwhile, a contracted mechanical quality inflection is sitting right ahead in 2028. The 12-month target is $38, about 31% upside, anchored on 11.2 times 2027 EBITDA. That's the level where three independent methods converge. The sum of the parts base case at 37.7, the Monte Carlo mean at 38.4, and the street high at 38. Longer-term fair value is higher, 42 to 48. The implied 5-year return at today's price is 18.7%, and about 71% of modeled outcomes sit above the current price, with the skew running 3.7 to 1 in favor of the upside. The way to play it, if you're playing it, accumulate on weakness, especially toward that 25 to 26 IPO base, and size the position with respect for the single basin risk and the share overhang. Use the execution milestones through the back half of 2026 and 2027 as your scorecard. And the line in the sand is around 18.5, the price that would say the market has rejected the contracted floor itself. That's Waterbridge, a compounder sitting just before an inflection, priced like a no-growth cash sink. The whole thesis rests on execution, and the market is waiting for proof. If that proof shows up, the gap closes. One more time because it matters. This is research for your own analysis, not investment advice. All of it is current as of early June 2026, and the forward numbers carry real uncertainty. Pressure test the assumptions yourself. Thanks for listening. I'll see you in the next one.